Good afternoon, and welcome to the Netwealth Investor webinar that we have this afternoon with Tracey McNaughton from UBS, presenting on index opportunity funds and evolved strategy for today's investment climate. As always, there's a question box to ask questions, and we'll get to those at the end of the presentation, so feel free to send them through. The webinar is being recorded and everyone will receive a copy via email in the next 24 hours along with the slides, so be sure to keep an eye out in your inbox for that. As always, any information presented here is general information. If you need specialist advice, please consult a professional financial advisor. So on to today's webinar. I'll just quickly introduce Tracey. A bit of background information on Tracey. She's been with UBS since 2013 in the role of Head of Investment Strategy Australia. Prior to that, she was with Colonial First State Asset Management as a Senior Investment Specialist, and she's also worked in the UK. She has a range of qualifications, including being a member of the Chartered Financial Analysts Association, as well as a degree from the University of Newcastle, a Bachelor of Economics. So we're really pleased to have Tracey along, and without further delay, over to you, Tracey.
Okay, well, thank you, and good afternoon, everybody. Thank you for joining us. The topic of this presentation is the Index Opportunities Fund, an evolved strategy for today's investment climate. We at UBS have been doing multi-asset investing, balanced fund investing for over 35 years now. We have one of the oldest balanced funds actually in Australia. And one thing that we have learned is that in order to survive, you must evolve. The market is constantly changing, our clients' needs are always changing, and new technology is always being developed. The Index Opportunity Fund is a result of that evolution. So just to look briefly at the investment environment and how it has changed, the two charts on the left-hand side there show what the investment climate was like back in the 1990s, and this was a period colloquially known as the Great Moderation. This was a period when investment returns were very high. You can see that on average over this decade, equities were giving you an average annual return of 18% every single year. Bonds were also giving you a very attractive 7.5% return every single year on average. The other key feature, though, of this period was that volatility was very low, and you can see that in the blue bars underneath that chart. If we then fast forward and look at the noughties, so the charts on the right-hand side, from 2000 to 2016, this period is now known as the Great Volatility. But you can see here we're in a vastly different return environment. Equities now are just giving you an average return of 2.2%. So if you're invested in the ASX 200, your average return on average over this 16-year period has been just 2.2%. Bonds are still fairly attractive but lower at 5.4% on average over the entire period. So you can see quite clearly that returns are now much lower in this environment. The other thing to note, though, is that volatility is higher, and you can see the blue bars underneath are spiking now so much higher compared to the Great Moderation period. So this is a new environment that we're in, and in order for us to remain relevant with our clients, we have needed to evolve. And that's where the Index Opportunity Fund comes into it. What does an evolved balanced fund look like? Well, it has to have a couple of very key features in this climate. It needs to be low cost. Lower returns means that portfolio costs have to come down. Passive building blocks reduces the trading costs and so keeps the overall structure of the balanced fund very cost effective. The second key feature is that it needs to be stable. We are in a more volatile environment now, and that means that diversification is key. You need to be as diversified as you possibly can across different asset classes, across different countries, regions, sectors, etc. Diversification enhances your stability. And the third key feature that you need in an evolved strategy like this is that it has to be active. A set and forget strategy is no longer sufficient in this environment. You can no longer just buy a portfolio that's completely passive and put it in the bottom drawer. That's no longer sufficient. More volatility brings opportunity to add value. So how do we do it? How do we build this low-cost, stable and active fund? I'll go through each of the points in turn. In terms of the low cost, the design of the Index Opportunity Fund is made up predominantly of ETFs, exchange traded funds. And I'll talk in a second about what an ETF is, but essentially it's a managed fund made up of a number of different companies that track a particular index. And so you can buy and sell this managed fund on the ASX exchange, and it will track the overall ASX 200 for you. So we like ETFs because they are cheap building blocks, they are very liquid, and they are very varied. So building a portfolio exclusively using ETFs is now possible with exposure to all of the major asset classes available. We use these as our starting position, if you like, to build up our strategic benchmark. You can achieve the target exposure to each asset class by investing in different ETFs. And as I said, the benefit of ETFs is that they provide investors with a simple and cost-effective way to obtain diversified exposure to an asset class via a single trade. So it cuts down on transaction costs. You can see here the growth in the ETF market, and this is how we have taken advantage of the new technology and products that are available to us. So the number of ETFs that are available globally is now around 4,400 different ETFs that you can invest in. The overall size of the ETF market is expected to more than double, from around $3 trillion worth today to over $7 trillion by 2021. Now this chart is just a great illustration of just how many different ETFs that you can possibly buy out there, and how diverse the world of ETFs really is. The line down the middle splits the universe into the US universe on the left-hand side and international ETFs on the right-hand side. The market in ETFs becomes more granular as you head down the page, and the bottom right-hand side you can see that you can buy ETFs for bonds, for commodities, for currency. If you have a view on the South African rand, you can invest in the ETF that tracks the currency ticker for the South African rand. If you want to invest in lithium miners, you can invest in a lithium ETF. If you want to invest in social responsibility, you can invest in an ETF that tracks socially responsible companies. The point here is that there is an ETF for everything. And so just to reiterate, this new technology allows us to build portfolios that are cheaper to construct and that keeps the cost to our clients down. So what is an ETF? An ETF is just an investment fund that is traded on a stock exchange. It can be traded on the Australian Stock Exchange, on the New York Stock Exchange, London, on many different exchanges. So you can buy and sell it as easily as you can buy and sell, say, a CBA stock. The ETF is built up of underlying assets and trades at its net asset value over the course of the day. And as I said, most ETFs track an index such as the ASX 200 equity index. So how do you use ETFs to build a balanced portfolio? Well, first of all, the reason that we use ETFs is because it offers us lots of diversification in a single trade. It's a very liquid instrument, which is very important for us. Liquidity means that it's easy to get in and out of the position if we need to. It's tax efficient, it's low cost, and it's transparent. But when we're selecting the ETFs, we're not just going out and buying any old ETFs. We have to think about the ETFs that we're buying. The ETF selection criteria that we use, it has to map the strategy that we're trying to replicate. We have to look at the index construction. We have to look at how diversified the ETF is. We have to look at how closely the ETF actually tracks the index that we're trying to replicate. And also it's important that the ETF is very large in size in terms of the volume so that it's very easy to get in and out. That decreases the trading costs and expenses, as you can see there. So using ETFs in the Index Opportunities Fund, we build up our portfolio using a number of ETFs as well as some passive pooled funds that replicate the exposure to bonds, to equities and listed property. So for example, we use the UBS IQ MSCI Australia ETF to gain our Australian equity exposure. We then adjust the weights to those ETFs on a regular basis in order to reflect our particular views on the market at the time. So for example, we are quite cautious in our investment views at the moment, so we have a 15% allocation to cash. We took this allocation out of our international bonds ETF positions, which is the dark brown in the slide here. The second aspect that's very important to an evolved strategy like this is that it has to be stable. Being as diversified as possible is critical in an environment where volatility is heightened. Picking the next best big winner is particularly challenging, so it's best to spread your portfolio across as many different asset classes and sectors as you possibly can. Every asset class, we know this for sure, every asset class at one time or another spends some time in the sun. And I would imagine that there would be few people out there who would have guessed that emerging markets would not only have returned you 68.9% in 2009, but after recording a minus 48.9% in 2008. So given that it's very difficult to pick the next big winner, being diversified across all is pretty important. The final feature of an evolved strategy such as this is being active. It's very important in today's climate to be active in your management. You have to win by not losing. And the table on the left-hand side is an arithmetic reality. Basically, if you lose 10% in your fund, you will need an 11% return in order to get back to your starting position. That's just arithmetically correct. If you lose 50%, you'll need 100% on the upside, and so on. So every loss requires an exponentially higher gain in order to recover. That's how the maths works. Losing, so not only feels painful, but it takes more work to get back to where you were. So it's critical that you have some active management. It can reach the point where losses become so great that recovery will never happen. The chart there on the right-hand side shows you the ASX 200. In the space of 18 months, The GFC, the global financial crisis that we had in 2008, wiped over 50% from the Australian share market. That's the chart there that you can see the big drop down. The ASX today is still languishing some 20% below its 2007 peak. That's 8 years on, and we're still not back to break even. So you have to wonder how many more years it would take before that 50% loss is finally recouped. So this is the importance of active management, particularly in a volatile environment. You actually win by not losing. So putting it all together, the Index Opportunity Fund has a passive foundation made up of predominantly ETFs, but it also has an active overlay so that we can take advantage of volatility in the market and also protect against that volatility. So just to summarise, they're the three key points that we want to leave you with in terms of the key features of the Index Opportunity Fund. It's low cost because we have passive foundation, passive building blocks that reduces our trading costs. It's stable because it's diversified. The foundation is based on diversified ETFs. And it's active. In an volatile environment, active means added alpha or added value for our investors. So that's the fund. What I'd like to do now and spend the last few minutes of the presentation is talking about some of the issues that we're talking about in our asset allocation meetings. So just to look briefly at how 2016 is going, it's been a challenging year. The place to be really has been in emerging markets, which not too many people would have picked, as I said earlier. The most challenging markets to be in have been Japan, the TOPIX, and the DAX, which is Germany, which is quite surprising given that central banks in those two countries have been most active in pumping money into the markets there. Bonds have given you very attractive returns right across the board, but in particular in the UK, and also Australian bonds have given you a very attractive return. And in terms of currencies, the Australian dollar has been the standout performer there. No surprises given where commodity prices have been. The Australian dollar tends to trade very closely with commodity prices, and you can see there that iron ore, which is our most important commodity, has really surged so far this year. These are some of the issues that are trending in our meetings. We're talking a lot about the dollar, about China, about obviously Donald Trump and Fed rate rises and geopolitical risks. But these are the top 5 issues, and the first one being lower for longer. Economic growth is lower across most countries, certainly across the developed world. This chart here shows you average economic growth over the last 10 years for Australia, US, Europe and Japan, and then compares that with the average growth over the 10 years prior to that. And so you can see that these numbers are lower over the last 10 years. I said it's a developed market story. Emerging markets actually have increased their average growth over the 10-year period, but certainly for developed markets, we're in a lower for longer environment. And of course, lower for longer means that we're experiencing lower inflation, which is the chart on the left-hand side there. You can see the change in inflation across a number of different countries over the last 3 years. Is down quite significantly. Inflation is a lot lower. The only places really where it's not are in the high-risk countries like Brazil, South Africa and Russia. Lower growth also means lower interest rates, and the chart on the right-hand side shows you how bond yields and interest rates in general have come down right across the board, and that explains why bond returns have been so attractive, because bond prices move inversely or in the opposite direction to yields, but interest rates are coming down as well. What does this mean for investors? Well, lower interest rates means lower returns. And this chart, I won't go into the details of it, but basically this is how you build up the returns in different asset classes that you're investing in. And what it's basically saying is that as you take on more risk, you get a higher return for taking on that risk. But the environment that we're in means that this line has not only shifted lower, but it's also flattened. So you get paid less for the extra risk that you take. That's the lower returns environment that we are now in. The second issue that we discuss a lot is China, and I have to say I think we're fairly comfortable and relaxed on China right now. It does seem that the economy there has stabilised. The Chinese government has stepped in with quite significant fiscal stimulus, and that has had a direct effect in improving economic and financial conditions in China. If there is one aspect to China that we are concerned about, it's the housing market. House prices in this chart on the right-hand side, you can see, have increased quite significantly, and in fact these numbers were updated yesterday, and if I'd updated this chart it would be up more around the 8% level. The reason that housing is such an issue for us in China is because there is so much wealth tied up in the housing market in China. About 40% of household wealth is in the housing market in China. So that is an important sector to watch and to make sure there's no bursting of any bubbles there. The third issue that we are talking about here is what we've called quantitative failure, or more generally speaking, the failure of central banks to really stimulate growth. What this chart here shows you is that the recovery that we've experienced in the US since the global financial crisis has been the weakest since World War II. That's quite remarkable, particularly when you consider that since the global financial crisis there has been 670 interest rate cuts globally around the world. That works out to be one interest rate cut every 3 working days. Despite that, despite the amount of stimulus that central banks have pumped into the economies, we're still in an era where we've got low growth. So the question is why? And I think there's a couple of answers to that, but broadly speaking, these are structural issues. One of the reasons for low growth is that we have an older population across most developed markets right now, which means there's fewer workers, so that translates into lower growth. We also have excess capacity that we're still trying to soak up after the financial crisis. If you think about the additional productive capacity that was pumped into the economy in the lead up to the GFC, it was like a balloon. I describe it to people as like a balloon. It continued to be inflated, all this additional capacity in the economy. New hotels, new manufacturing plants, new houses, etc. But when the GFC hit, it was like putting a pin to the balloon and busting it. So now, not only do we have to repair the damage to the balloon, but also it's taking a lot longer to reinflate that. And so that's one of the reasons why growth is still so weak, despite 8 years on from the crisis and a massive 670 interest rate cuts. One of the issues that is really coming to the fore, and we're seeing it on the news just about every night with Donald Trump and Hillary Clinton in the US election, is the rise in inequality. And the reason why inequality has increased is principally because countries and economies have been reliant on monetary policy to get us out of the hole that we're in after the crisis. The problem with that is that monetary policy puts upward pressure on asset prices. That's how monetary policy works. It increases asset prices. The issue there is that not everybody owns assets. And these assets, I'm talking about houses and I'm talking about equities. Not everybody owns equities. Not everybody owns houses. And so as a result of this 670 interest rate cuts, there's been large proportions of electorates right around the world who have been left behind. And so there's this growing feeling now that inequality needs to be addressed, which is why we're seeing what we're seeing with the US election. This is the ugliest presidential election in history. Neither candidate is particularly well liked. It's really a vote for which one you hate less. But we feel fairly confident that that given how the electoral system, the college electoral voting system works in the US, that Hillary Clinton has around an 85% probability of winning on the 8th of November. But really what I wanted to talk about here was to highlight that fringe politics is really beginning to get more and more airplay. That's an issue. And you can see here in this chart here, populist parties and politicians right around the world are polling very strongly. These are, for the most part, far right, but there's also some far left political parties that are beginning to get a foothold here. These are the populist parties that are voicing the pent-up concerns and anger of the vast majority of people who have been left behind by the policies of central banks. Why is that a problem? Well, it's a problem because it hampers the ability of governments to govern. And we know this simply in our own economy. Looking at Australia, you know, Australia in 2010, we had the first minority government in 40 years. In 2013, a quarter of the electorate voted for minority parties. And in 2016, we had a double dissolution election for the first time in 70 years. So this is not just happening in the US and Europe, but it's also being reflected in Australia. The minority populist parties are gaining a foothold because they're speaking for the masses that have been left behind. And that is making it very difficult for people like Malcolm Turnbull to get reforms through Parliament because you have a split Parliament or a split Congress. So remember, tax reform was on the top of the agenda for Malcolm Turnbull when he came into office. That's now not even being spoken about. We can't even get a plebiscite through the House of Reps, let alone tax reform. So it causes a depletion of capital, it causes political fragmentation, which then leads to weak and divided governments, which then translates into limited economic reforms and short-sighted policy making, where politicians are making policy just for the next election and not for the longer term. This is unfortunate because we're right at a time now where we need governments to step up and support the central banks, and this unfortunately is at a time when they have limited capacity to do so. The final issue I just want to touch on quickly is Australia. I think we're fairly optimistic actually on Australia on a relative basis. The Australian economy has done remarkably well to transition through the biggest mining boom in a generation without going through a recession. We're now 25 years of uninterrupted growth. The world record for uninterrupted growth, incidentally, is held by the Netherlands at 26 years. So next year we'll hold the world record for the longest period of uninterrupted growth, which is great. There are problems with the Australian economy, there's no doubt about that. One of the issues with Australia is the fact that we have very weak wages growth, very low incomes growth, and that's as a result of the collapse in our commodity prices. But as you saw in the first slide that I showed, our commodities are beginning to rebound, and so we are starting to see an end to that incomes slowdown, if you like. So just to finish up with some conclusions here, I think as investors at the moment we are quite cautious. We are looking at some big events coming up into the end of the year. not just the 8th of November US presidential election, but also in particular actually on December the 4th, there is a referendum on constitutional reform in Italy. And that has the potential to actually be more disruptive and create more volatility than the US election. Italy is under some strain right now with its banks in disarray, and the Prime Minister Renzi, has said that if he doesn't get his constitutional reform through, which basically is reform to try and make it easier to pass legislation through the Parliament, if he doesn't get that reform through, he has said that he will step down. At the moment, the polling for that is 30% support, 30% don't support, and 30% are undecided. And so we're watching that very closely. If Renzi does have to step down, then we have a political crisis on our hands. We'll have a downgrade. The credit rating agencies will downgrade Italy, and we'll have to have fresh elections. And as you saw in the table previously, the far right in Italy are polling very strongly. So if they begin to get more and more of a foothold in Italy, then we all of a sudden stop talking about Brexit and start talking about whether Italy wants to leave the euro. So for that reason, we are justifiably, I think, being cautious, and that is why we have a 15% allocation to cash in our balanced fund. The credibility of monetary policy is also being questioned. We're quite concerned on this, mainly because once you start questioning the credibility and once trust in the central bankers diminishes, their operational efficiency declines. Everything in credit markets, in financial markets, it hinges so importantly on trust. As long as there's trust there, then you've got things working correctly. But as soon as financial markets begin to doubt the ability of central banks to grow the economy, then we have some major issues on our hands. We do think that central banks still have the ability to grow the economy, so we're not too concerned about that, but certainly it's something to watch. The geopolitical risks I've already mentioned, and into next year I think political risk is going to be one of the big issues to watch, particularly in Europe, where we have national elections coming up for France, where President François Hollande has the lowest popularity rating of any French president in the history of modern France. So he's going to have a difficult time of it. And the far right is polling very well there as well. We have national elections in Germany, where Angela Merkel needs to refocus her attention away from migration and refugee issues and more onto the domestic economy. We have an election in the Netherlands and also in Hungary. So it's going to be all focused on Europe in particular for next year. Overall, we are sitting on neutral in equities, which means that we are not taking any tilts away from our starting allocations in our ETFs. We're underweight bonds, and we've put the money that we've taken out of the bond ETFs, we've put that money into cash for the time being. We think at the moment cash is really the only safe hiding place for you to go. Maybe 12 months ago we would have said bonds is a good place to hide and wait for the event risk to pass. Today we're saying actually bonds and equities are equally potentially a cause for concern over the coming months, and so we like cash. I'll finish with the final slide here, which shows our views broadly on where to invest across equities, across bonds and fixed income, and across currencies. You can see the markets that we're finding the most attractive are emerging markets. We like Europe. We also, in terms of bonds, we like Australia and some corporate credit. We think that there's a nice attractive yield to be had from the corporate bond market. And in terms of the currencies, We have a preference for the US dollar, and actually think that potentially the Aussie dollar has some further chance to slide a little bit further. I think the thing that everybody's talking about, of course, is the US elections, but as I said, I think the market is pricing in a Clinton victory. If we don't get a Clinton victory and we do get Trump winning on November 8, then I suspect equity markets will sell off pretty heavily, but probably will sell off more heavily outside of the US than inside the US. With that, I'll finish there and more than happy to take some questions. Thank you.
Thanks, Tracey. That was very informative and a great overview of the index opportunities funds that we offer through Netwealth here, run by UBS. I'll just finish with the disclaimer there for UBS as well. Obviously, it's general information this afternoon, and if you need personal advice, seek out a qualified advisor. I'll just let Tracey grab a glass of water, but as she touched on, more than happy to take questions. There's been some that have come through, so we'll start with those, but there is a box there to send through queries at the bottom of your presentation. So one of the queries, Tracey, was regarding the popularity of ETFs. If their popularity continues, I think you touched on they're growing at $3 trillion, or they're at $3 trillion at the moment. If they continue to grow, do you think there would be detrimental effects to their performance with that high level of growth over time?
Well, no, I don't think so. I think the capacity for ETFs, we're talking about going to $7 trillion by 2021. The overall size of the market is many multiples of that. So I think at the moment 4,400 ETFs in number. I guess one of the big areas of growth for ETF is becoming more finely tuned and more specific ETFs, which is a part of the market that we don't particularly play in, because the more specific the ETF, the more expensive it is.
Okay.
And for us, as I said, it's always number one, how much is this going to cost us?
Mm-hmm.
So I don't think it's going to be an issue for many, many years.
Okay. Okay, so the market's capacity to handle the investment in ETFs is more than enough there.
Correct.
Yeah.
Yes.
Okay. Well, that's.
I mean, I think, sorry, just to add on to that, you talk about $7 trillion. The overall market cap of the Australian market, is what, close to $2 trillion, 1.8 trillion. So, and that's just Australia, and we're 2% of the world. So,
yes,
so do the math.
It's mind-boggling to think about, isn't it?
Correct. So the capacity is huge.
Okay, yeah, so that's interesting. And on to the next query about, you touched on house prices in China. Obviously house prices are getting a lot of play in Australia as well. I think you mentioned that 40% of wealth in China is tied up in houses. I don't have the Australian figures at hand, but I think a lot of our wealth is tied up in residential housing as well. What's your view on the residential housing market at the moment? Do you see a bubble forming, or what's your take?
You're right, there is a lot of wealth in Australia tied up. It's about 60% in Australia. I think first thing to say about the Australian housing market is that housing markets in Australia, as elsewhere, well, for the most part, they don't die of old age. They have to be killed off. And so knowing that, they are normally killed off by one of two things: by higher interest rates and or by a rise in the unemployment rate. And so when we look at the Australian market, our view there is that interest rates in Australia are on hold for the time being. We got a CPI reading out today at 11:30, which was just prior to coming in, so I'm not sure what that reading was. But our view is that the Reserve Bank here is on hold at 1.5% for the time being. So no interest rate rises, and the labour market is doing okay. Most of the growth in jobs at the moment is in part-time not so much in full-time, but the unemployment rate is sort of still tracking on a downward trend.
Mm-hmm.
So we can't see anything that will kill off this housing market. Having said that, it can't really continue at the rapid pace, and we know that the Reserve Bank are watching it very closely. They are relying more and more on macroprudential measures to rein it in, and by that we mean they're relying on the banks to tighten up the lending restrictions and increase the size of the deposit that you've got to have, particularly for investors. And so the investor part of the market is actually starting to subside, which is good. A lot of it is being driven by foreign investors. We're noticing that is depleting a little bit as well. So I think it's not going to collapse unless we get a number of interest rate rises. I think for now, until at least the middle of next year, I would be confident in saying that that it'll continue to sort of track along sideways.
Okay, so no immediate headlines about fall in house prices or anything you don't think in the sort of the immediate to near term?
I think there will be pockets. I mean, I should qualify that. You know, always coming into Melbourne, it always surprises me to see the number of cranes on the skyline, and so there certainly will be pockets where there's oversupply, and CBD Melbourne and CBD Sydney seems to be key areas there. In New South Wales, we're at record levels of building approvals. Not all of those will get constructed, I'm sure, but we are at record levels. But I think so you need to be very discerning as an investor as to where you want to purchase. But it's clear that it is now a policy of the government to address the affordability issue. They've been talking about that now for the last few days, and so they're going to make sure that the supply is there. So I wouldn't be investing, but I certainly don't think that there's a collapse coming.
Okay. Onto the US economy. What are UBS's forecasts for US growth in the next 12 to 24 months?
I think at the moment it's tracking at around a 1% growth rate, which is not good. It's below trend. I think it's going to be challenged by rising interest rates in the US. They're not going to be significant rises. We do think the US will raise rates in December. That's one of the reasons why we think volatility is going to rise. A rate hike in December is almost assured. It's also, though, being challenged by the strong US dollar. The US dollar has risen quite a lot, and that undermines the international competitiveness of the export sector in the US. So we're looking for growth to maybe tick up to around 2%, maybe a little bit higher than that. But certainly, given that you think about what are the key drivers of growth in an economy, and it's three things. It's productivity, it's population growth, and it's the participation in the labour force. In the US, more than in Australia, population growth actually is not growing that great. In Australia, it's about 1.5%. It's less than that in the US. Productivity has fallen through the floor in the US, also in Australia, because there has been no investment in new plant and equipment, no new technologies have been coming through, so productivity is slowing down. And the participation rate in the workforce is also declining because the older population are now retiring, so they're exiting.
Dropping out.
And so these three factors are all causing growth to be challenged in the US.
On to a query that came through about Brexit. So just on your chart there of far-right parties becoming prominent on the electoral scene around the world, and obviously Brexit happened earlier this year and caused markets to get skittish. Has any information come through about a detrimental effect to the UK on their yes to Brexit and leaving the EU as yet, or is it still waiting for more concrete evidence on how that will play out?
It was all sort of played as usual right up until the UK Conservative Party had their Congress, and the UK Conservative Prime Minister Theresa May began to speak.
Okay.
And that's when the pound sterling really started to fall and collapse. So what she is outlining is what's being known in the market as a hard Brexit, that is, that it's going to be tough, that, you know, it is possible to live outside of the euro, and Norway and Switzerland have done it, but they've got nice soft arrangements with the EU. What Theresa May and the UK are talking about is nothing like that. She wants to end the free flow of labour across borders, and Europe have come back to her and said, well, the free flow of labour, of capital, and of services are interlinked. They're not separable.
Okay.
And this is a real problem for the UK, because the UK, the biggest thing that the UK does for Europe is sell financial services into Europe. So if Theresa May is so adamant that she's speaking for the people to want to stop immigration coming into the UK, then at the same time, the hard Brexit scenario is defined as, well, okay, we'll also stop buying your financial services.
Okay.
And that will cause a recession in the UK, and that's why the pound is falling. I think Theresa May, and I should have put a picture of her on that slide with Trump, because she is, the sorts of things that she's talking about sound very dangerous to me. She's talking about wanting to revert back to a planned economy, having an industry policy. Australia moved away from an industry policy with the button car plan, you know, when we only had two different kinds of cars in Australia, Ford and Holden.
Okay.
She's talking about wanting to cherry pick the industries that will get support from government, which I think is terrible, because governments are bad at
picking the winners,
at making allocations of resources. You should leave that sort of thing to the market, and she doesn't seem to be doing that. So I'm watching what she says very closely. The UK, I think, are going to have some difficult times ahead.
Okay, oh, well, that's interesting. It'll be interesting to watch the political scene in America and the UK on the back of their big decisions. Just back locally on the Australian market, a more specific query about, where do you think the Aussie market will finish by the end of the year and into the next sort of 6 to 12 months? Pull a crystal ball out sort of prediction. There, Tracey, it's sitting at about 5,400, the ASX 200 today. Do you see any meaningful growth in the price index for the next 6 to 12 months?
Well, I think you think about the Australian market. It's made up predominantly of banks and of miners. And so any view on the overall Australian market, you have to think about what's the outlook for those two sectors. So for miners, the thing you have to think about is what's the outlook for China. I think overall there does seem to be some stabilisation, as I said, so it is possible that commodity prices will maybe even tick up a little bit. We've seen the Japanese negotiate a very attractive 100% increase in the coke and coal spot price. That's going to do wonders for the budget and for income coming into this country. So on that, I'm reasonably optimistic. On the banks, I'm less optimistic on. I think we are seeing banks being hammered right across the world, mainly because regulators have come out post the GFC and said, right, you guys have got us into this trouble, now we're going to rein you in, and you need to set aside more capital on your balance sheet, which inhibits their ability to lend and to make money. And so I think there's going to be the requirement for Australian banks to set aside yet more capital.
Okay.
And in addition to that, the other thing that's going to hamper Australian banks is the housing market. And if you think on a 12-month basis, certainly it might not be collapsing, but it's not going to be growing at the same rate it was.
Okay.
And so that's going to hamper banks' profitability as well.
A few headwinds there on meaningful growth in the near term.
There is a few headwinds. So, I mean, and it also so critically hinges on the US election because, as I said, emerging markets and Australia will be wrapped up into this being a commodity producer. will be most affected if Trump wins. And so that's an outlier. That's our 15% probability case, but that will definitely affect the Australian market. So, the ASX is up 2% so far for 2016. I think it's, around there is our expectation that it'll finish the year at.
Okay, well, I think that's about all we've got time for, Tracey. So thanks for outlining the funds that you offer there, the index opportunities funds. They're available through the Netwealth platform, so you can see those on our website, netwealth.com.au, or talk to your financial advisor. They'd be more than happy to chat to you about them. As always, if you have any further queries, feel free to get in touch with us here at Netwealth. More than happy to take you through what we offer in a bit more detail. The email will be out in the next 24 hours with a copy of the presentation. Slides will also be included. Again, thanks for your time, and we look forward to seeing you soon.